Have we gotten to a point that we need to stop talking about the Fed raising rates? Do they need to step in, and how do they step in if that is the case?
I got to tell you, that's a great question, and the central question of where interest rates are going. It's not only interest rates in terms of treasuries. What's happened in the United States is we've seen credit spreads in corporate bonds, high-yield bonds, mortgage bonds narrow to treasuries. And now, after yesterday's rout, while the 10 years up about 3/8 today, what people are worrying about is how this affects the mortgage markets, corporate buybacks, corporate issuance, refinancings, loans at the banks. And I can tell you, because I speak with a lot of the largest money managers in the country, that there's great concern about interest rates and where they're going and what it's going to do to the economy in the United States.
It's funny, isn't it? The optimism around markets is suddenly creating the case for that recovery not to be on track. I know it's a funny sentence, but have we gotten then to a point when perhaps the White House might start to put some pressure on monetary policy authorities to maybe do something ahead of stimulus?
Yes, I think that the odds, I was asked that question a number of times today, I think the odds are about 60-40 that the Biden administration is going to put tremendous pressure through Janet Yellen on the Fed in terms of expanding their balance sheet once again. What we've seen is a very direct correlation, not only with bonds, but with equities between the sides of the Fed balance sheet and interest rates and the stock markets in the United States. And I think that the odds are better than 50-50 that this pressure is going to come and the Fed is going to have to step in, because if they don't, then we could see interest rates, the 10-year, for instance, back at a 1.75 or 2%, which are the two next technical levels. And that would cause a fair amount of havoc in the United States markets.
Mark, how is the Fed likely looking at that then? That's 175. I know you're looking at that now. We're close to 150 now, 147 on the US 10-year. It's not just about the level, it's the pace of the increase in these yields, as has become increasingly clear over the last few days. How important is the level then and the pace for the Fed?
I think they're both very important. What we saw today was durable goods is one example, showing the economy. Durable goods orders were up 3.4%. The consensus view is up 1.1%. So we're seeing the U.S. economy bounce back. But the question is what the Fed is going to do, whether they're going to expand their balance sheets, whether they're going to keep interest rates low. Interest rates certainly in America are much higher than Europe, as an example, where the 10-year German Bund is minus 2.34. We're much higher rates than in Japan, and so the question is the Fed on a concerted basis going to do something? And of course, with all the stimulus, that means more borrowing from the Treasury, and if the Fed doesn't do something, I'm afraid that it's going to cause even more difficulties in the United States and the economy here. And I think the Fed is going to get pressured very heavily to step up their game and come back in. And I think that's the central question. As you know, the central banks, including the Fed, have been the major driver of both interest rates and the equity markets since the financial crisis of 2008 and 2009. They've been the 800-pound gorilla in the room, if you will. And now it's a question of what they're going to do, and that's what everybody's speculating about. That is the center of thought in the United States. What are they going to do now?
Okay, so Mark, where are you looking for shelter then in this environment?
You know, I've been on Wall Street a very long time. It'll be 47 years in April. And for the last 5 years, I agreed to help some people and institutions, and what I said was in closed-end funds and ETFs, if you know what you're doing, you can get some double-digit yields, and it's been a very, my opinion, good place to put part of your money. And I continue to think if you can find double-digit yields, especially funds with a monthly payment, which obviously adds compounding interest to the equation, you're in great shape when, at the moment, as you said, the 10-year Treasury is at 1.48%. But again, the whole issue is going to be the Fed and going to be the other central banks, the ECB and the Bank of Japan, and what they're going to do to respond to this sell-off and these concerns about inflation.
And Mark, I guess as a final question then, is there a chance we're overreacting to this, or is this really something that is crucial, this bedrock of low rates? What are your thoughts on this moving forward? Is this simply another headline, these 24 hours, we move to something else next week, or do you think this is something to watch very, very closely?
No, I think it's a very good question. I think it's something to watch very closely. The interest rates and the assets at the central banks have been the main drivers of the markets for the last 12 years or so, and I don't think that's going to change. But if we found that the ECB and the Fed and the Bank of Japan and so forth, Bank of Switzerland, were not going to respond to this, then we could go to substantially higher rates, the 1.75, 2% on the American 10-year, which would cause havoc, as I said, not only in the Treasury markets, but the risk capital markets, corporate bonds, mortgage bonds, high-yield bonds. We just hit in the United States 2 weeks ago the lowest rate ever on the Barclays Bloomberg High Yield Index. Now we're backing up, and everybody is going, what's going to happen? And when, of course, you see the Dow Jones trading today off almost 560 points, people are concerned, I can assure you.